Good afternoon and welcome to everyone attending today's event. It's nice to see we have such a wide and international audience with us today. In a short 20-minute webinar, I would like to give you some insight into the economic symposium that happened now in Jackson Hole. My name is Massimo Grassotti. I work with investor relations towards institutional clients in continental Europe. Today we have the pleasure of having Anders Borg, former Minister of Finance for Sweden and expert advisor to East Capital, as well as Jacob Grapengiesser, partner and deputy CIO for East Capital Group. There's been a lot of anticipation ahead of the symposium, so let's dive right in. Anders, before we get into the details, if you could give us a little bit of an overview and some key takeaways from the event.
Yes, Massimo, I do think that Powell really delivered on expectations. They are sticking to the new framework. Fed will accept inflation and tolerate inflation above 2%. He gave a very pedagogical argument for why disinflation is temporary. It is used cars and some other supply issues, and basically argued that some of the disinflationary forces that we've seen over the years are also still in work. So it's quite likely that Fed are heading towards tapering. That's in the cards, and I think also well in line with what Powell said. But he is in no hurry. He is not worried. He do think that inflation is coming up, but in a way that is tolerable and in line with Fed's expectations.
Yeah. Well, with the decline in output during the second quarter of 2020, twice what it was during the Great Recession, we've seen an enormous record even recover of outputs. You know, in the last 4 quarters, we've surpassed previous peaks. What does this mean for emerging markets, and should we be worried at the rate at which we've been covering?
Well, first of all, it's good for emerging market. Global growth coming back, world trade recovering means that the emerging market countries are back on a decent growth trajectory. So it's good for them that Federal Reserve, ECB, and other central banks are cutting rates. It's good for them that we see very expansionary fiscal policy in China, Europe, and the US, because this implies that we have a decent backdrop for emerging markets. The fact that Fed is heading towards tapering implies that there will be a little bit of pressure during the autumn. Countries with large current account deficits or high inflation or increased political risk will face some headwinds. But one should note that the emerging market universe in general is in much better shape than back in 2012. Tapering has been well announced, and many of the central banks have already hiked their rates to keep inflation under control and to reinforce their credibility. So I think emerging market is in a better position than they were back in 2012.
Mm. Yeah, I fully support that. I think one word, though, that one needs to pay some attention to is really inflation, because in the West, we are used to very low or zero inflation or the threat of deflation. Mm. In emerging markets, the fear of inflation is always there. So inflation expectations go up quite quickly in emerging markets, which they don't do in developed markets. So this is also why Anders mentioned that some of the central banks have been hiking. You know, Russia, Brazil, Mexico, etc., have already been kind of preemptively hiking their rates, which I think is a good thing and a prudent way to handle it. I think the other effect for emerging markets is that a lot of the commodity prices are up significantly compared to pre-COVID. So I think most of us look at crude price as the key commodity, and it's effectively flat since the beginning of 2000. But if you look on gas prices, they're up 300%. So it's just massive. If you look on copper prices, which is part of this whole kind of renewable investment theme, it's up 50%. If you look on steel prices, which is part of this global capex cycle, they're up between 50 to 100%, depending on where in the world and what type of steel. Yeah. So it's a massive boom in commodities, which has gone, I think, a little bit unnoticed.
Yeah, absolutely. And Anders, what do you believe will be the overall sentiment? I mean, the market, although markets following the comments from Jay Powell that even though it will be gradual and it will be data driven, tapering is coming. There's no putting it off.
No, I think definitely tapering is coming, and we are in a kind of a mature market. The big bounce back after the crisis has already taken place. This is a period where we will see increased discount rates. We will see multiple contraction, and it is a market where you really have to be an active portfolio manager, because you really need to find growth, you need to find profitability. You have to have some moats that can actually provide support for that profitability. It's a little bit of an environment where you want to be both a growth and a value investor. Every case has to stand on its own merits and be well supported.
Yeah. Well, I would put it this way. We are now in the world of very loose monetary conditions. We are speaking about, 3 months down the line starting to taper. But the tapering process will probably be another, let's say, 8 months.
Yeah.
So next summer, we're going to be over with the tapering. But until then, for American investors to say it's like a punch bowl and you pour liquor into the punch bowl. I mean, we're still pouring liquor at max speed into this punch bowl. And in 3 months' time, we will start to pour just a little bit less liquor into it.
Mm.
So the conditions are still there, right? So if we look on global markets, of course, money is going into stock markets because that's I think the obvious home. Stock markets are, depending a bit how you see it, expensive or not expensive. But if you compare to other asset classes, probably equities is the most attractive asset class.
Yeah.
So I think you will have some volatility. You will have some fears of inflation coming up. But net, I mean, I think the trend will be upwards, albeit with maybe slightly high volatility. If you take a step back and you look at the different type of markets, well, emerging markets are down 2% this year, mostly because of China, admittedly, but they're still down. Developed markets are up 16%. So, it's close to 20% performance spread. It's a very large spread. If you look on the valuations, emerging markets are at 13 times earnings with 41% growth. The US is at 21 times earnings with 21% growth. So you have, close to half the valuation in emerging markets with almost exactly double the growth. So it's a very big difference. And of course, just, logically at some point, these kind of trends reverse, right? So emerging markets will come back in favor. Then the question is maybe what will perform within emerging markets? And that's a separate discussion.
Yeah, that was a great analogy there. But with regards to tapering, then, I believe Powell did a great job of reassuring the public and telling them that, hikes and rates and hiking rates as well as tapering, that they're not one, that they don't influence each other essentially. But once headline starts reading that they're tapering, do you think we'll see panic?
Well, I would be very careful of trying to kind of moonwalk a little bit out of the more vulnerable cases. But we have talked a lot about Russia, and that I think is a little bit of the opposite, because with this commodity prices and very low marginal cost in their production and solid macroeconomic backdrop, I would say that you have to discriminate between the different countries, where I think Russia would be, from my perspective, on the stronger side.
Yeah, absolutely. It's I think in Eastern Europe you have Turkey and you have Russia, and Turkey is probably the most fragile, and Russia is I think by far the strongest of all emerging markets in terms of macro.
Yeah.
Lowest state debt to GDP in the world of any big economy, large current account surplus, etc. And I mentioned also the commodity prices here. So Russia is a big crude exporter, but they're also big exporters of all of these other commodities, which is maybe not as well known by the market. If you look on Russia in particular, so Russia is now trading at 6.6 times earnings with a 140% profit growth for this year and an 8% dividend yield. So 6.6 times earnings. It was actually 8 times earnings in the beginning of the year, and the market is up 24% this year. But the P ratio went down because profits basically grew much more than the market performance, right?
Yeah.
So I think Russia is really the obvious kind of value play. So I think for investors overall, what you will see is that you will see volatility in what they call the long end of US curve, right? So this is 10, 20-year bonds. This is also the discount rate. So your high growth companies, your tech companies, etc., they will probably face some volatility. And when that kind of themes comes back to the market, then people will search for value plays, low PE companies, and then Russia is just the best value play that there is. I mean, there's just nothing that beats it really with these type of numbers. And again, Russia is one of the world's best markets this year, but actually the P ratio came down, which is a bit ironic, right? You would think that it sort of came up. Yeah.
So then, I mean, touching on exactly what you're saying then, so in a market such as this one where it is so volatile, Russia is a good place to look then?
Oh, absolutely. I mean, it has done well. I think for now, the market is not so focused on value, actually, global markets, because the long end of the curve in the US is low, actually. So now a bit of growth and tech and so on is back in favor. But as soon as you see volatility, and at some point during the fall, you will see it. Then these value plays will basically be back and very high up on investors' kind of wish list and radar screens.
Yeah. So you still believe in the case as strongly as ever?
For Russia, yes, absolutely. I think for other emerging markets, you need to be just very selective. And emerging markets is really about navigating both the kind of corporate landscape and finding the right companies and how they tie into politics in the respective markets. So if you look on China now, for example, Alibaba, Tencent, these are tech giants that are absolutely fantastic companies. But they were a little bit too fantastic, a little bit too good, and a little bit too powerful for the Chinese government, which is why they cracked down on them. Yeah. So I think this is just the type of angle you need to take into account in emerging markets that you don't really need to look for in Europe and the US.
Yeah. Well, can we assume then, then based on what both of you said, that investors will look to find steady growth and profitability in companies, not only in Russia, but maybe, more in emerging markets? Or are we looking at seeing more people move into maybe value plays just as Russia then? Or are we seeing maybe a bit more of a split in between the two?
I think it's a little bit different pockets, as they say, of money, right? So I think probably investors are a bit afraid of inflation. Those fears are going to come back. I think they probably want to keep some kind of small pocket of their portfolio in like deep value plays. And I think Russia is sort of that pocket. It might not be very big, but it's like your most inflation protected type of pocket in the portfolio.
Yeah.
For emerging markets, I would say it's more about top-down allocations. Should the performance gap be 20% year to date? Probably not.
Yeah.
Should it be half the valuation versus the US with double the profit growth? Probably not, right? So I just think that investors eventually always look at fundamentals, and I think that's basically where we are now. So I think emerging markets partially suffered because of a strong dollar and fears of tapering, but I think this tapering news is just so well known by the markets that it simply will have a very kind of limited effect. And then I think just investors will calm down and they will look at these numbers, and then I think that's really the case for emerging markets.
I think it's also important to note that it's not a tapering decision. It is a tapering process that will be driven by data and outcomes. And if Powell is right, he's willing to accept higher inflation. He thinks that the economy is quite resilient in terms of this long-term disinflation. Well, then the Fed will not be in a hurry to step back from the expansionary policy. It will be a process. It will be data driven. So it's not that we will come beyond tapering because we're in December. It will be an ongoing discussion the whole spring. How much inflation is there? How worried should we be? So we'll be back at these discussions time after time. And I think the arguments for example, for Russia in terms of very low valuations where the PE is actually lower than the direct dividend is an interesting alternative if you want to hide in some type of value protection.
Yeah, absolutely. Well, with that, I'd like to thank all our clients who participated virtually. I'd like to thank Anders Borg and Jacob for your expert insights. Please reach out to your IR representatives if you'd like more information or to set up meetings with our team. Thank you, and we look forward to seeing you soon.